I'm James Turk. I'm a director of the GoldMoney Foundation, and it's my pleasure to be here today with Folker Hellmeyer, the chief analyst of Bremer Landesbank. Folker, it's a pleasure, to meet you, and I've got a number of things I want to talk to you about, but let's start with the German economy. It looks like the economy is really softening over the past couple of months, and it might be going into a recession. Do you see a recession coming?
I'm not seeing a recession coming. Well, what we are seeing is a loss of dynamics in the German economy as well as in the world economy. There's a very close relationship between the German and the world economy. We've seen that back in 2009 was a downturn. Germany suffered extremely. It has to do with the fact that 22% of German GDP are created by the productive sector. And in that respect, of course, we feel the chilliness of the world economy currently. But the good thing about it is that there is a big difference to the year 2008, 2009. And the global economic cycle, we don't have any opportunistic characteristics, which was the case in 2008. The global inventory cycle has no really high level at the current stage, and the same accounts for the capital investment cycle as well as the consumption cycle. The consumption cycle is being determined by income and not by new debt. And on the capital investment cycle, we are running at a very, very low level. In that respect, what we are seeing in the German economy is that there are no cancellations of orders, which was the case in 2008, 2009. And the German economy, whether we talk about the chemical industry or whether we talk about companies producing capital goods, is not, and also the car industry, we are not seeing any really weakness. We are seeing weaker orders, but basically these industries are will fully operate for the next 10 to 12 months.
Is there any change in terms of where the demand is coming from? Is demand in Europe declining and demand in Asia picking up?
Well, we're seeing that the German demand is very, very stable, and we see on the order side a lack of foreign orders currently. On the consumption cycle, we see a very, very stable environment of a slight improvement.
What about inflation? They say it's 3%. I think it's probably more than that. ECB just lowered interest rates 0.25% or 0.5%. More inflation?
Well, I'm claiming that inflation will go back to the level of the 80s in the global economy. Why? There's a genuine misunderstanding about the reason why we had a disinflationary environment in the past 15 years. It had to do with the opening after the fall of the communism, and we had overcapacities in the labor markets, in the global labor markets, and also given the aspect of capital. And these aspects, what we are seeing now is that in the emerging market countries, inflation is picking up because the capacities, the overcapacities they offer to the world economy throughout the last 20 years have been used up, at least those that were cheaply to be exploited. And we see inflation in India at 9%, in China at 6%, South America 5 to 10%, in the US at 3.9%, in the Eurozone at 3%, UK 5%. The fact is, the reason for the pickup of inflation has to do with a lack of overcapacities in comparison to past years. And in that respect, unless the world economy doesn't go into a global recession, I can't see inflation really receding. The central banks got it wrong for the last 2 years. If you look at the forecasts of the Fed, of the ECB, their forecasts on the inflation have been terribly wrong, and they will remain wrong in my eyes. I see a further pickup, slight pickup next year in inflation. On the inflationary side, in that respect, the central bank policies are a little bit anti-authoritarian, I would say. Some of the 68 generation obviously conquered central banks in the Western world.
Do you see double-digit inflation?
I can't see it currently, but in case that we enlarge the money supply furthermore in a very aggressive fashion, we cannot rule it out. But for the current time, I think we will see higher inflation. At the pass, I would say, for the next years, for the Eurozone, something in between 2.5% to 5.5%. For the US and UK, it's higher the way they calculate, and I want to point out in America in particular, the way they calculate, it's going to be something in between 3 to 7%. And if you take John Williams' shadow government statistics, you know that the way to calculate inflation was much better in 1990. One of the reasons why you see the impoverishment of the middle class in the US has to do with the wrong level of consumer price inflation due to the Boston Commission back in 1992, I think it was.
Yeah, I follow John Williams's work very closely, and just for the benefit of the viewers of this video, one of the things that he does is he uses the model to calculate inflation that the federal government in the states used back in 1980 when President Carter was still in the White House, without any of the subsequent changes that have been made to it. And according to that model, the inflation rate today in the United States is 11%, not the stated, a much lower number.
And I think an implicit proof of John Williams being right to use these methodologies is the fact that you see the impoverishment. I mean, you're standing in the US, I think at the moment, as a rate of 15.1%. And it's a different impoverishment than in Western Europe, where we still have a very well-equipped social welfare system. So being poor in America is something different from being poor in Europe.
Yeah, in fact, I just wrote about this in the sense that the highest standard of living that America has reached actually occurred in 1973. Since 1973, the standard of living as measured by real wealth, the real standard of living, has been declining, and that was absolutely the peak. And I drew the conclusion that it was in part from 1971 when the U.S. went off the gold standard and was debasing, the currency as a consequence. But I was actually going to ask you a question about that without the background information. We're talking about inflation, and you're talking about increasing of the money supply, but something else is going on here in Europe, similar to what happened in the U.S., that the ECB is debasing the currency by bringing a lot of low-quality assets onto the ECB balance sheet. And that ultimately could mean higher purchasing power, higher inflation or less purchasing power, just because the currency is worth less because of asset quality debasement. In other words, you have quantitative easing, but you also have qualitative easing, debasing of the assets of the ECB.
Yes and no. I mean, first of all, any purchases of the ECB of bonds of Italy, Spain, Greece, Ireland, or whatever, is being sterilized by monetary measures. In that respect, there's a big difference between the approaches of the Bank of England, the Bank of Japan, or the Federal Reserve in the United States. Secondly, I want to point out one thing, and I'm very shocked about that. The fact is that European countries are, in my eyes, in a much better shape than they are reported to be. To give you a clue, take Ireland. Ireland went under the umbrella of the European mechanism in October 2010. At that time, Ireland held a liquidity reserve of 25% of GDP, 47 billion. And they wouldn't have needed the capital markets until end of 2013. And these aspects are absolutely not discounted in financial markets. Let's talk about Italy, yes. They have a debt of 120% of GDP. They stood at 114% of GDP when they entered in 1999 into the euro, so we have an increase of 6% after the harshest crisis since 1929-32. In the same time frame, the US indebtedness, if you take the public debt from the US Treasury, we had an increase from less than 50% to 100%. That is a bit of a dynamic, not the 6% of Italy. The next point is Italy is rich. The government owns so many parts of the economy, so we shouldn't only look at the debt, but we also have to look at the assets of the government. Italy has got a primary surplus of 3% of GDP. That's the best number in the Eurozone. Why don't we discuss these things? We have currently a situation where there's an aggressive speculation against Eurozone countries where they just look at negative aspects and they don't focus on positive aspects, and they also don't focus on the progress of reforms. Go back to Ireland. Ireland is performing very well. They were marked down by rating agencies aggressively within months. Now things improve. Why don't we see a grade up? If you grade down quickly, you should grade up quickly. It's not happening. This is ridiculous. Talk about Spain. Spain has a debt GDP ratio of 68%. Germany has got 83, but Spain is in danger of going bankrupt. They managed to get down the building industry from 11% of GDP to 4% within the last 3 years. Nobody talks about it. And the whole structure of this country is absolutely in order. They are, together with Germany, leading in the technical environment of alternative energies, etc. They are second biggest supplier of car components, etc. So things are not as dire as they are reported.
Why are people focusing on the negative rather than the positive? Is it a reflection of the fact that, in the post-Lehman Brothers collapse, everybody's worried about, what's going to be the next collapse, and therefore they ignore the positives and just focus on the negatives?
Yes and no, but I think there's a political side to it. I mean, look at the Eurozone. The Eurozone has got the debt GDP ratio of 85% currently. The UK stands at 90, the US 100, and Japan at 230. So given the debt GDP ratio, we are basically top of the pack. Look at the new debt. 2009, Eurozone 6.3, US more 11, UK 11, Japan more than 10. 2010, 6% Eurozone, US 12, UK 11, Japan somewhere towards the 20s and 30s. This year, Eurozone 4.3, US 9, and the UK at 10, and Japan more than 10. Again, we are outperforming all of the others. We are champion of the reform agenda. We implemented the first reforms back in the fourth quarter 2009. No other region of the world has had more severe reforms than the Eurozone. And this basically top performer within the Western industrialized world, Japan, UK, US, this top performer is being attacked by speculation. Now let's talk why. So I think there's a political taste to it, and the political taste is clearly as writing on the wall. The US is doing no reforms, is having high indebtedness, still lots of structural problems being unresolved, having a government which is not able to implement reforms due to the standstill between Democrats and Republicans, but it's out of the focus. Europe is the focus. The UK has got a very weak economic environment. They are not hitting the targets of debt reduction, but nobody cares. But if it happens in the Eurozone, everybody cares. So we have an asymmetric approach of financial markets, and to me this has got a very, very big political taste. And I think it's a scandal. Yeah. We shouldn't bring the best performing region to the slaughterhouse. It wouldn't make sense in my eyes.
But how's this going to play out? Because it does look like the vultures are circling and focusing on the periphery, taking them out one by one, or planning to, or at least that's what it seems to be headed. From time to time I'm invited into Berlin, and what I've been saying throughout the last 18 months is we need ring fencing in the Eurozone. And they wouldn't have listened. What is happening now is a sort of ring fencing with the EFSF. And I want to point out one more thing. The FSF and putting leverage onto it is one thing. The other thing is the ECB. The ECB has got reserves amounting 383 billion euros. So that's lots of firepower. And I think they understood the message, that this is not only a thing where the market is discounting fairly, but that this is also a competition regarding power. Yeah. Do you believe the euro then is going to get through this crisis?
I'm positive, because from what I hear from the central banking side, from the political side, is that they understand the topic now more completely, at least, as they did before July 2011.
Mm-hmm. But is Northern Europe going to have to bail out Southern Europe?
Up to a certain extent, yes, but I'm not having a problem with that. As I said, I think the Italian fundamentals are much better. In that respect is the current interest rate they pay at the capital markets for 10-year bonds at more than 6%, quite a bonanza. I wouldn't buy any German bond at the current stage. I would buy Irish bonds, I would buy Spanish bonds and Italian bonds, because these countries are well on the way. The point is, well, we have to take care that there is no disintegration of the Eurozone. The disintegration of the Eurozone would simply have a psychological shock effect on Europe, and then reforms and the progress of reforms will not be discounted at all.
Yeah. Let me ask you one thing. I'd like to focus on the way the Bundesbank used to operate, in that it was completely separate and completely independent from the political process, from the government itself. But the ECB seems to have been drawn into the political process, and that's different than the way the Bundesbank operated. Doesn't that ultimately mean that that's going to weaken the euro? Because now that it's under the political process, rather than making the tough decisions, like back in May 2010, they told the ECB to buy, Greek government bonds, rather than making the tough decision, don't buy Greek government bonds. Isn't that going to ultimately weaken the euro, and that in itself will cause problems for the eurozone?
Indeed, yes, but I want to take it from a different point. If somebody suffers from a heart attack, there are two chances. Either you give him a helping hand and dial 999, or you say to him, well, I know you smoked, somebody who suffered heart attack, you smoked, you drank too much, and you did eat too much and too much fast food. I belong to the part who says, I'll give this person a helping hand. And we're having a heart attack of our financial system. The ECB is still standing for a relative stability approach, I would call it that way. We are sterilizing these interventions, but in a world that has changed so much and is facing the toughest crisis since 1929, 1932, you can't play to an orthodox central bank rule like the Bundesbank had implemented. The Bundesbank was never faced with problems we are currently envisaging in the global and the Western world in particular. And in that respect, I think it's reasonable what the ECB is doing. I'm a fan of stability policy. And compared to the Fed, to the BOJ or the UK, the ECB is still very much on the stability path.
Yeah, I agree with you completely in the sense that the Bundesbank has never faced quite the crisis that the ECB facing. But I mean, back in the 1970s, I remember very well what at that time was considered to be a major crisis as the Deutschmark was strengthening relative to the other currencies, what it was going to do to the German economy. But eventually, German economy, German producers, companies became more efficient and they dealt with that crisis. But I guess what I'm getting at is that, when the EU was put together, the ECB was put together, certain rules were laid out. And, you either follow the rules or you break the rules. And when you break the rules, consequences usually are bad. And, throughout the EU, you see countries breaking rules. They're breaking rules on the deficit spending as a percentage of GDP. You're seeing the ECB breaking rules in terms of buying government debt. Isn't that bad?
It is bad, full stop. No doubt about it.
The rules were there in the first place in order to prevent the currency from being debased, correct?
But the rules were set up back in 1992. And in 1992, as I said, communism failed in 1990. And from 1990 onwards, we had a shift. We had deregulation, where things were just getting out of hands. The perfect market requires a polypoly. And we've moved in financial industries towards an oligopoly. And if you look at special markets, we can even talk about a monopoly. So we've set up a financial architecture which is not comparable to the 1990-1992 window when these rules were set up. We've seen a globalization where everything is intertwined and interconnected, and we've seen a deregulation which has increased the power of single institutes to an extent. Well, we have to answer the question, if we play to the orthodox rules of the Bundesbank or of the Treaty of 1992, we will have a global depression straight away, a meltdown of the global financial system, and we will have as a consequence a global instability in politics. And that may be worse in 1929, 1932, because then economies were not that intertwined. And think about Germany in 1933. That was a result out of problems. And I simply say, I'd rather break a couple of rules instead of allowing a situation where where millions of people will die on the road. And I have one more argument for that approach. If you look at the global economy, we in the Western world tend to focus on the United States or on Europe, discussing the merits of certain measures. Fact is, in the world economy, we've got 51% of world GDP produced by emerging market countries meanwhile. And they don't have our problems in that sense. Look at China, they've got that GDP ratio of 15%. Look at their consumption loans, 0%. Savings rate, 40%. Now China is standing out, but basically emerging markets, 51% of the world economy does not have our problems. 20% of the world economy are strong economies like Australia, like Canada, the Northern European belt, producing capital investment goods. with indebtednesses that are okay. They should be also should be lowered. But anyway, we have 71% of the world economy being intact. 7% are being reformed. We are talking about the Garlic zone of Euroland, plus Ireland and the UK. And these reforms in the Eurozone are the utmost stringent reforms in the history of industrialized nations. They will take effect. Then we talk about 78%, which, looking forward, will be okay. Remaining is Japan and the US. 5% of the world GDP, or 4%, is Japan. They are imploding. There is not much of a virus into the world economy because simply they are financed by themselves. But it's a big problem, and the rest of the problem is the United States, 17–18% of world GDP. And that is a problem because none of the structural problems has been addressed over the last decade. Instead, things have worsened over the time. And all the measures being taken are cosmetic. And every woman getting older knows cosmetic can play a very good role for a while, but eventually you will have to cut. And that is what America will have to the path America will have to choose, otherwise America will lose more and more status within the world economy. But what I want to say is we have 70% of the world economy being basically intact, and I'm not willing to risk, just to have an orthodox policy, this 70%, then I play to different rules, but again the ECB in comparison has got still a high degree of stability policy involved.
Just going back to the rules one more time, the rules that were established in 1992 were basically the rules that the Bundesbank in Germany followed from 1950 to 2000, and it enabled the Deutschmark, to be the best performing, world currency during that period of time. Are you saying those rules don't make sense anymore?
They make sense, but the question is, do we choose an evolutionary path or a revolutionary path? A revolutionary path would be the implementation of the Bundesbank policies, and we let it just simply fail. That has got its charm, but the consequences are dire. Once you choose this way, you won't get the consequences out of the way. So once you take this decision, the aftermath will just simply be a domino effect, as I said, throughout the world financial system, depression in the world economy, and political instability. And in that respect, I think the evolutionary path is much better. And again, I want to come back to the reform again of the Eurozone. Ireland is well on the way. Portugal. We've seen that also with Spain. They are performing, yes. And now we come to Italy. The fundamentals are still in line and are have got a lot of potential. Basically, no reason why to sell off Italy. And now they implement reforms and adding up to an amount of 100 billion euros. And yesterday they said, all right, we will be checked with the implementation of the reforms by the EU, by the IMF. We are changing Eurozone here. We are changing the whole business model of the weak countries currently. And we don't get any, let's say, positive discount for that. Instead, we get a negative one, and that is ridiculous.
I understand what you're saying, and I think you're making the case that most of the political leaders would be making, but will the people who vote ultimately see that?
Well, if German professors like Mr. Zinn or people like Mr. Henkel keep on with their propaganda against the Eurozone, for example in Germany, it's not likely to happen. But the fact is that the mood within the Eurozone is changing. That is my...
changing in what way?
In the way that they see that the Eurozone makes a lot of sense. And I want to give you an example. I mean, I'm very often on German TV. But recently, we are getting much more appearances where I talk about the progress, which is not being done by my colleagues. And I think my colleagues have performed unprofessionally and unacademically, because simply they just look at one side of the coin, and that is, in my eyes, unprofessional, yes.
Is the attitude in other countries changing as well? Or?
Well, when you look at France or at Spain, people are in favor of the Eurozone. Now you can say, okay, they promise themselves to have benefits in the current situation. Yes, of course. I think the utmost critical countries where the general population is critical is Finland, it's Austria, and it's Germany. Apart from that, I think there's a lot of consensus pro-Europe. And also, if we had a referendum in Greece, I'm very sure that it would be positive with an outcome of 60 to 70% improvement for a simple reason. If Greece turns against the reform agenda, anybody who's got a job, and there's 85% of the workforce, basically signs themselves into unemployment. But we won't get the referendum anyway. In that respect, this discussion is rather theoretical.
It's speculative. How do you see things unfolding then over the next several months?
Well, I think the approach in July, with the EFSF being enlarged and possibly given leverage to it, together with the support lines now by the IMF, with liquidity lines to countries that run into problems, together with the pressure of G20, in particular out of the Asian region, will morph into a situation where the progress in the Eurozone will come more into the forefront. I'm very, very positive that the Eurozone will gather momentum and will have a different standing in 2012 than in 2011. But there are still a lot of risks prevalent, but I remain positive on this count. And also I want to point out, I mentioned that earlier, if you look at the global cycles in the economy, we've seen a reduction of the global dynamics due to political risks. The very moment these political risks recede, we will see a pop-up of the global economy. Currently, my colleagues are calling down global growth forecasts for 2012 and also central banks, etc. And I feel very relieved. They got it wrong since 2007, so they're going to get it wrong here again. What we are saying next year is, for instance, I'm coming from Hamburg, I'm very Hanseatic, so I like understatement. I'm saying the IMF call for global growth of 4% is in line with my forecast, but qualified as a Hanseatic approach. If my theory is right, we will see next year that risks are receding, that the progress in the Eurozone is being discounted, the political risk is diminished. If that is going to happen, we will see global growth next year standing at 5%, high inflationary pressures. And talking about the German economy, the 5 wise men called for a growth next year of 0.8%. In the muddled through scenario, which is the Hanseatic one for the Eurozone, I call for 1.7, and if things go like I favor, I see 3% growth in Germany next year.
Yeah, but with a higher inflation rate.
High inflation rate.
That's it. Is that a cost that you're willing to absorb in order to enable the Eurozone to continue operating?
Yes. And I think we lived very well back in the 80s with a comparatively high level of inflation. And one way of overcoming the high indebtedness of the public sector is, in my eyes, that people, in particular in the US and UK, want a certain degree of inflation in order to inflate away the debt. Now that is, of course, not a fair deal to those who run their finances in a conservative fashion. And I'm not saying it's good, but I'm going to say it's going to happen.
Yeah, on both sides of the Atlantic.
Both sides of the Atlantic, but then again, if you look to Switzerland, if you look to continental Europe, it will be less dynamic than in the US and the UK.
So the US dollar will fall relative to the euro?
I see the US coming under pressure, and I think that is a genuine trend which started back, we can go back to 1971, closing the gold window, and it's a long-lasting trend, and it corresponds also with the share of the which they have in the global economy. Go back 30 years, America's share of the global economy was standing somewhere close to 30%. They are now at 17%, and they have creative accounting. Also, the GDP is creative accounting. I mean, the growth numbers being produced over there and productivity numbers, they are very suspicious. I'm again here with John Williams. And I wrote a book, Finally Outspoken, the translation, and I was also looking at US statistics. I mean, they are a little bit, the quality is comparable to the statistics of Moscow back in 1985. Marketing, enchanting, but not necessarily corresponding to the real economy.
Yeah. How do you see the US unfolding? I'm very skeptical that they're going to get back on the right road. and that the dollar is going to continue to be in trouble. I mean, the last month the U.S. government borrowed $200 billion in 1 month. You know, these are unsustainable.
It is unsustainable. America needs a shift. Let's talk about the setup of an economy. Now, the productive sector producing goods is on average in industrialized nations at 14% of GDP. So 14% of GDP is producing goods. That's the average. Germany stands at 22%, which is high. Ireland at 25%, very strong economy, with growth of 13.7% back in 2010 in that sector. Now America stands at 9%. And again, the creative accounting is very visible because producing hamburgers and cheeseburgers is part of industrial production. America needs to address this topic, get production back into the country. That's high-paid jobs. That is capital stock of the economy. Unless they start to look into these fields and start changing the roads they took back in the early 90s, America will lose status. That's one thing. And the other thing, let's talk about Republicans and Democrats. Under Clinton, we had a situation where, with the public debt in 2000, which only increased by 18 billion US dollars. At that time, the share of income tax stood at 10.4% of GDP. Now it stands at 6%, which is a low basically since 1947. And we have very high public debt. And now Republicans and Tea Party participants call for lower taxes in order to overcome the debt problems. Now this is ridiculous. America needs to raise taxes for those who can afford. That's a deal of the society. America needs to overcome the environment of running an elite and impoverishing the rest of the nation. And these fields need to be addressed. If they are not addressed, America will fail.
Do you see raising taxes more important than cutting spending?
I think both are important, but raising taxes is something where I can have an immediate impact, and where the social freedom is being improved. And we have the Occupy Wall Street movement now, so the split, in order to heal the split, that is simply necessary in my eyes. And we need to cut spending. And one field is very easy to cut, which is the military sector. But that does not go very well with the Republicans, I presume.
Yeah. I just did an analysis and an article on this recently. U.S. government spending at all levels of government is just over 41%, about of the total GDP, and it's never been this high ever, even during the Second World War, which to me suggests that government has become too big, and that the private sector, which is really where wealth is created, has to grow. So, I would like to see a dramatic cut in government spending and enable the private sector to do what it does best, which is create wealth, because after all, the wealth the government spends comes from the private sector. That's
also in school, but again, the point is, how do you generate that? If you do it from now, if you do it immediately, you run a higher risk of derailing the whole economy. What you need to do is, and again here I'm calling for the evolutionary path, is just to change the direction of your policies and take steps that are not too harsh to derail the economy. Because in order to get fiscal healing, you need a performing economy. Let's talk about Greece, for instance. We've seen a contraction of the GDP throughout the last 2 years by 10%. And they managed to get down new debt from 15.4 of GDP down to 8.5. Proves, by the way, the success of structural reforms being implemented throughout the last 2 years. People don't look at that currently. They are very one-sided, but we need, in order to have a real fiscal healing, a further positive performance of the economy. That is very, very helpful, and that makes the, let's say, cuts for the general population more tolerable. Yeah. Let me just wrap up by asking a couple of questions about gold. We seem to be starved for capital these days. The banks are over-leveraged, governments are over-leveraged, but there is a lot of gold, here in Europe, 10,000 tons more or less. One way to account for a new level of capital and bring the overvaluation of currencies back down to a more realistic level is to take that existing gold stock
and revalue it at some higher number, you know, like 5,000 or 8,000 euros per ounce. And essentially you are accounting for new capital in terms of what that accumulated gold has been. Do you see gold coming into the equation as Europe looks for capital to solve some of the debt issues that it's facing? You know, could that, for example, be a way that you recapitalize the ECB?
Yes, clearly and outspoken, yes, it's one way, but we need a global approach on that. That's what I think is
Europe
feasible.
can't do it alone.
Europe won't do it alone, because simply then you have a political price being implemented. No, that won't happen that way.
Europe could lead by going alone, and others would have to follow, wouldn't they? Because the European economy is so big relative to global economy.
But what I think is we will see a different approach. We will see that due to the fact that the emerging markets and central banks like PBOC, the People's Banks of China, etc., they accumulate gold in a very strong fashion. And not only them, it's generally the whole part of the emerging market countries looking into precious metals. They go back, they say this trial period from 1971 to 2011, when no gold standard was there, simply went wrong. This is what we can say today. And even I think Sulik of the World Bank said gold will play a major role in the future. And I totally agree on that. Gold will be money again. Whether it is for the normal citizen is a different question, but on central bank, on governmental basis, it will get the status again within the next 5 to 10 years. I'm very sure about that, and that will go along with a price which is a lot higher. I'm not willing to give any forecast on where gold or silver will go within the next 5 to 10 years, but what I will say is it will be much, much stronger than it is currently, and people simply have no fantasy of where the real fair price could be.
Yeah. Because of that outlook, do you think that individuals should accumulate gold and silver then as a way of diversifying their portfolio and protecting?
Absolutely. We have a kind of financial repression, the way Western governments work nowadays, with interest rates lower than inflation rates. And one way to escape from these mechanisms is that any individual sets up his own gold and silver standard. And that's what I've been doing since 2001. And it has been very wise. And I have also a recipe how to trade. If you have 100 tickets which you invest, you play with 30. You always remain long 70. So you catch the trend with 70. If it goes into a blow-up phase, you're long 70. And with 30 you trade, you sell when it's high, rebuy when it's low. I've been doing that for the past 10 years, and I will keep on doing it for the next.
And in an uncertain, unpredictable future, you know, gold is sort of a safe haven that
Indeed.
Makes sense.
It can't be printed. Some ETFs try to print it. And I'm looking very much into the physical demand equation. And the physical demand equation tells you one story. This gold and precious metals are in demand, full stop. And you can fool markets a while with paper gold or paper silver, but you can't fool it for a longer period of time. And if you look at charts over the last 3, 4, 5 years, what you can see is that the up moves are very strong, and back in the first part of the last decade, the correction phase was very steep and very prolonged. It's less steep and it's less prolonged. And it shows that our friends in the Wall Street and in the City of London and some other players are not in a very comfortable place currently.
Yeah, and higher gold, higher silver over time is likely.
And you've got to see it as an investment. Any time where we see aggressive sell-offs, I'm very happy because it offers opportunity. It's the only subsidy of central bank intervention I do accept for my own money.
Yeah, good point. Thank you very much. Well, Folker, this has been a real pleasure. I've been speaking with Folker Hellmeyer of Bremer Landesbank. Thank you very much.
Thank you. Go into a global recession. I can't see inflation really receding. The central banks got it wrong for the last 2 years. If you look at the forecasts of the Fed, of the ECB, their forecasts on the inflation have been terribly wrong, and they will remain wrong in my eyes. I see a further pickup, slight pickup next year in inflation. On the inflationary side, in that respect, the central bank policies are a little bit anti-authoritarian, I would say. Some of the 68 generation obviously conquered central banks in the Western world.
Do you see double-digit inflation?
I can't see it currently, but in case that we enlarge the money supply furthermore in a very aggressive fashion, we cannot rule it out. But for the current time, I think we will see higher inflation at the path, I would say, for the next years. For the Eurozone, something in between 2.5% to 5.5%. For the US and UK, it's higher the way they calculate, and I want to point out in America in particular, the way they calculate, it's going to be something in between 3 to 7%. And if you take John Williams' shadow government statistics, you know that the way to calculate inflation was much better in 1990. One of the reasons why you see the impoverishment of the middle class in the
US. I think it's probably more than that. ECB just lowered interest rates 0.25% or 0.5%. More inflation?
Well, I'm claiming that inflation will go back to the level of the 80s in the global economy. Why? There's a genuine misunderstanding about the reason why we had a disinflationary environment in the past 15 years. It had to do with the opening after the fall of the communism, and we had overcapacities in the labor markets, in the global labor markets, and also given the aspect of capital. In these aspects, what we are seeing now is that in the emerging market countries, inflation is picking up because the capacities, the overcapacities they offered to the world economy throughout the last 20 years have been used up, at least those that were cheaply to be exploited. And we see inflation in India at 9%, in China at 6%, South America 5 to 10%. In the US at 3.9, in the Eurozone at 3, UK 5. The fact is, the reason for the pickup of inflation has to do with a lack of overcapacities in comparison to past years. And in that respect, unless the world economy doesn't
I'm James Turk. I'm a director of the GoldMoney Foundation, and it's my pleasure to be here today with Folker Hellmeyer, the chief analyst of Bremer Landesbank. Folker, it's a pleasure, to meet you, and I've got a number of things I want to talk to you about, but let's start with the German economy. It looks like the economy is really softening over the past couple of months, and it might be going into a recession. Do you see a recession coming?
I'm not seeing a recession coming. Well, what we are seeing is a loss of dynamics in the German economy as well as in the world economy. There's a very close relationship between the German and the world economy. We've seen that back in 2009 was a downturn. Germany suffered extremely. It has to do with the fact that 22% of German GDP are created by the productive sector. And in that respect, of course, we feel the chilliness of the world economy currently. But the good thing about it is that there's a big difference to the year 2008, 2009. And the global economic cycle, we don't have any opportunistic characteristics, which was the case in 2008. It has to do with the wrong level of consumer price inflation due to the Boston Commission back in 1992, I think it was.
Yeah, I followed John Williams' work very closely, and just for the benefit of the viewers of this video, one of the things that he does is he uses the model to calculate inflation that the federal government in the States used back in 1980 when President Carter was still in the White House, without any of the subsequent changes that have been made to it. And according to that model, the inflation rate today in the United States is 11%, not the stated, a much lower number.
And I think an implicit proof of John Williams being right to use these methodologies is the fact that you see the impoverishment. I mean, you're standing in the US, I think at the moment, is a rate of 15.1%. And it's a different impoverishment than in Western Europe, where we still have a very well-equipped social welfare system. So being poor in America is something different from being poor in Europe.
Yeah, in fact, I just wrote about this in the sense that the highest standard of living that America has reached actually occurred in 1973. Since 1973, the standard of living is measured by real wealth, the real...
The global inventory cycle has no really high level at the current stage, and the same accounts for the capital investment cycle as well as the consumption cycle. The consumption cycle is being determined by income and not buy new debt. And on the capital investment cycle, we are running at a very, very low level. In that respect, what we are seeing in the German economy is that there are no cancellations of orders, which was the case in 2008, 2009. And the German economy, whether we talk about the chemical industry or whether we talk about companies producing capital goods, is not, and also the car industry, we are not seeing any really weakness. We are seeing weaker orders, but basically these industries are will fully operate for the next 10 to 12 months.
Is there any change in terms of where the demand is coming from? Is demand in Europe declining and demand in Asia picking up?
Well, we're seeing that the German demand is very, very stable, and we see on the order side a lack of foreign orders currently. On the consumption cycle, we see a very, very stable environment of a slight improvement.
What about inflation? You know, they say it's 3%.